So this is part 41 of this multi-part video series for positional stock traders. This is a trade management video. Okay. We have looked at the orange trading system. In the orange trading system, you start with filtering, shortlisting, stock selection with the help of liquidity analysis, comparative analysis, technical analysis, fundamental and market analysis. On the basis of that, you decide your position size, you execute the trade, you manage your risk using a stop loss, and then the last step is trade management. Now, there are multiple ways of managing a trade. In this video, I will teach you a very simple method of managing a trade, which you might probably know, but might not have experienced before. The simplest way of managing a trade is with the help of a moving average. Okay. You need something to tell you that this is the time to sell. Now, the first sell signal we already know, which is our green selling zone. So, on this stock, let us prepare a trade management plan. What is our trade management plan? Very simple. Once it crosses the pivot point, our first selling point will be where it goes into that green selling zone. So, we will sell one third there. We will take a 10% position size on this stock, assuming you did all the analysis and you arrived at this stock and you plan to buy 10%. So you will sell one third at the green selling zone. You will sell the next one third after it closes below the 10-week simple moving average, which is this blue line. You will sell the next one third, provided that close should be on low volume. If it comes on high volume, we have to sell everything. Okay. That's the basic golden rule of selling, that if it closes at the end of the week below that simple moving average on high volume, you have to be out of the stock. The game is over basically. So we will sell in three tranches. First, we will sell when the price reaches our green selling zone. That is, we'll sell one third there. Then we'll keep our stop loss to the break even. Then if the stock goes up, comes back and closes below the blue line, we'll sell another one third, provided that blue line, the close below the blue line comes on low volume. Okay. If it comes on high volume, we'll sell all. Then after our second sale, if it continues to bounce back and goes above the blue line, and when it closes below the blue line, we'll sell the remaining one third. Okay. That's the basic plan to start with. Okay. Now, this is the initial plan to begin with. Your plan might change as you go along because the fundamentals of the company might change, the market condition might change. Okay. Or you might be going on a vacation. You don't want to keep any stock in your portfolio. You just want to be in cash. After you come back from vacation, you just want to come back to the market. There could be many things that could happen when the stock is going up, right? There could be a number of reasons to sell. Maybe you need cash uh, out of your portfolio. There is some emergency in your family, some medical emergency. You need some money. So there could be a number of reasons to sell. But to begin with, this is our plan. Sell one third at the green selling zone, sell another one third at a close below the moving average, and sell another one third at a close below the moving average again if the stock continues to go up. Okay. Let's see how it plays out in this case. Okay. So this is BHEL weekly chart. This is an old chart, November 2023. So as per the SEBI regulations, we can use this chart for discussion and educational purpose. And have a look at this base. This is base number 2. The relative strength of the stock at this week's close was around 87, 89. So good relative strength. Every stock that I have shown you in this positional stock trading video series has got relative strength of more than 80, because that is what is shown on the market Smith chart. And anyways, we look at relative strength more than 70. So these charts are consistent with what we have discussed in comparative analysis. Okay. One, count the number of red bars in the base: 1, 2, 3, 4, 5, 6. Okay. Out of 6, how many are high volume? Only one. Okay. So that's a good base. It's a consolidation base. It's neither a cup nor a cup with handle, nor is it a double bottom, nor it is an ascending base, no flat base, no ascending base, no high tide flag. They just call it consolidation. Okay. Base number 2. And the high of this candle is the pivot point. Okay. So which is 148.90. So let's draw the pivot range. 148.90. So this is 148.90. Okay. This will be, I have my old school calculator. So 148.90 multiplied by 1.05 is 156. I'm not writing the decimals. Okay. So that's the buying range. Then the selling range. This will be 148.90 multiplied by 1.2 is 178. And this is 148.90 multiplied by 1.25, which is 186. It's very simple. Okay, you have the selling range. So we will buy 10% position size here, and then we'll sell one third here. One third of 10% is 3.33%. Okay. And then stop loss range, red color. This will be 148.90 multiplied by 0.92, 136. And this will be 148.90 multiplied by 0.95, which is 141. Okay, buying range, selling range, stop loss range. Now, trade management tactics are applicable only when the stock begins to go up. Okay, if the stock starts to fall and comes to your stop loss, you already know what to do. If the stock closes below the pivot on a weekly close, we have to sell everything, because you remember page number 261 in William O'Neill's book, true winners don't close below the pivot. Okay, so cutting your loss short, that's fairly simple. I wouldn't allow a stock to go to 8% stop loss. I would start cutting my position size very quickly if the stock doesn't go in my favor. But if the stock actually goes in my favor, then I have to manage the trade. Okay, I have to be very strategic in my selling decision. Okay, the reason why we sell partial is because we want to capture the full upswing of the stock, and at the same time take some money off the table, because if the stock hits this green zone and if you don't sell, and if the stock collapses and hits your stop loss, that would be emotionally very painful, right? So you have to take some money off the table, move your stop loss to break even, so that you neutralize the trade. What is the meaning of neutralizing the trade? It's like making the risk in the trade zero, correct? So now let's go to Monday. I will click here. Monday, nothing happens. Tuesday, Wednesday, Thursday. So 4 days, nothing has happened. The volume is closing into the average weekly volume, which is very good. The volume is 76 million. Average is 100 million. Okay. So on Friday, if you are getting the 24 million volume on Friday extra after this, that is going to be a high volume weekly breakout, right? Provided the price goes above and closes above the pivot point, right? Let's see what happens. So we are expecting 24 million volume. Look what happens. The stock not only breaks the pivot, it travels through the entire 5% pivot range. And the volume closes at 185 million, which means on Friday, the volume went from 76 million to 185. So 185 minus 76 is equal to 109 million. In a single day, the stock gave volume of 109 million, whereas on a weekly basis, the average weekly volume was around 100 million when the week started. Later it changed to 112, but expected was 100 million. We got 185 million. And out of that 185 million, 109 million came on one single day, which is Friday, which means Friday was an extremely high volume day. Okay, during which the price entered the blue zone, which means you got a chance to buy the stock three times inside that blue zone. So once when it touched the pivot point, crossed the pivot point, you would have first bought 50% of the total shares that you planned to buy, right? Then as it went up 1 or 2%, you bought another 30%. As it went up another 1 or 2%, you bought another 20%. So you took 10% position size on this stock on the same day, because the stock not only touched the lower part of the pivot range, but also the higher part of the pivot range. So it traveled the entire distance, that too on high volume. So you should have bought everything. Okay, all the shares that you planned. You wouldn't wait for the next week's Monday to arrive, because the volume is already exceeding like 185 million minus 112 million. That's 73 million, which is 65% above the average weekly volume, correct? And remember what is written in William O'Neill's book. If the actual volume is 50 to 100% above the average weekly volume, that's a good, decent, legitimate breakout, correct? For a proper breakout, we need the actual volume to be at least 50 to 100% more than the average weekly volume. Average weekly volume is something that we need mandatory. Okay. So let's say you put 10% of your portfolio in this stock. Okay. And where will be your stop loss? Your stop loss will be 8% below your average execution price. Who gives you your average execution price? Your broker gives you your average execution price. Okay. Now what do you do? Now you wait. Now you see the price action of the stock. If it closes below the pivot on a weekly time frame chart on Friday, you sell everything, right? Let's move forward. Monday, Tuesday, Wednesday, Thursday, Friday. Okay. There was only 4 days in this. So probably there was a public holiday here. Okay. So Monday we have now Tuesday. So Tuesday we got an opportunity to sell. The price entered the green selling zone. Here we don't look at volume, by the way. While selling, we don't look at volume, because we want the price to enter that selling zone so that we can book some gain there. Okay. Volume could be high as the price is coming down. That is why volume is not very important in that green selling zone. Volume is important in the blue zone because we are looking for a high volume breakout after a low volume consolidation, right? So this was a low volume consolidation and this was a high volume breakout. So now you sell one third here. Okay, so how much money do you make roughly? So let's say somewhere in between here you bought the uh, 10% position, and somewhere here you sell in the green zone, that's 18, 19%. So note it down, 19% is something that you make on your first one third. Okay, so on 3.33%, you make 19% roughly. Then you keep the remaining two third as long as it remains above the uh, 10-week simple moving average. So you keep the remaining two third, and your stop loss on that two third position size is now on uh, your break even. So even if the stock comes down, collapses, and reaches your stop loss, you don't lose any money on this position. You actually come out making 19% on at least one third of that position. Okay. Now let's see. Now we have to wait for a close below the 10-week simple moving average. Till that happen, we are not doing anything. This is our initial plan when we started. We are not looking at market conditions. We are not looking at change in fundamentals. We just go in with the basic plan that one third, one third, one third. We will only sell three times. Okay. One is when it goes into that green zone. Whenever we get the opportunity, you might not be in front of your screen on that Tuesday, but whenever you get a chance to open, because this is a 5% range, right? The stock might spend a few hours there or it might spend a few days there. So Whenever you get a chance to look at your mobile phone has this data if you have the trading view application. So it will show you that green color whenever you get a chance to open your mobile phone and you see that the stock is trading inside the green zone. You might want to offload one third of the total number of shares that you own. That is the advantage of a weekly positional trade because there is no hurry. Okay. I mean, the stock might spend a few hours in that green zone. You easily get enough time to sell and get out. And if it suddenly crosses that red zone on the upside without you noticing, that's like icing on the cake, right? You get a better selling price basically. So that's the advantage of weekly time frame. In this case, in a couple of weeks, you got an opportunity to sell, but generally that does not happen. It takes 3 to 4 weeks for the price to go up 20-25% from its pivot point. Even 3 to 4 weeks, 20-25% return is a fabulous return, right? And you get enough time to offload your shares. So let's say you sell one third, you make 19%. On the remaining two third, you move your stop loss to break even. So now you have 10 minus 0.33, which is 10 minus 3.33 is equal to, you have 6.66% position size left in the stock, which is basically risk free. Your stop loss is at break even. So now on that 6.6% position size, we are waiting for a close below the uh, 10-week simple moving average, which is the blue line. Irrespective of high volume, low volume, we don't care. Okay. Let's see what happens. When does it close below that blue line? Let's keep moving this forward and watch out for the red bars. Okay. Don't get afraid because of the red bar, because first of all, this is coming on low volume and it is not a weak closing because the stock has closed just at the midpoint of the bar. So it is not neither weak closing nor is it strong closing, and it is low volume, so nothing to worry about. Okay, let's continue. Let's see what happens. I will move it forward. See here, the stock tested the 10-week simple moving average, that too on high volume. On high volume, you have a strong closing. Why strong closing? Because the stock has closed above the midpoint of that bar. So strong closing, high volume, which means the stock has bounced off that 10-week simple moving average. How do you determine a bounce? A bounce is determined by a strong volume, right? It bounces off that. It touches the none of these bars touches the 10 week, but this bar touches, and it touches and it bounces from that, and it closes near the high of the bar. So very, very good sign, right? Let's see what happens next. You still haven't sold the remaining shares. Now look at this. Okay, this is coming on low volume, so nothing to worry about, right? This closing, weekly close is on low volume, so nothing to really of a concern for us. But remember what we planned initially. We planned that if the stock closes below the 10-week simple moving average, we will sell one third. Okay. So you sell out of the remaining 6.66%, you sell 3.33% here on Friday, just 5 minutes before 3:30 on Friday when the market is closing, you sell one third. So how much you make here? So let's measure from the blue zone somewhere here to this level at the close of this, just 42%. Okay. So you end up making 42% on that remaining one third. So 42 plus 19. So 61% you have made on a one third position. Okay. Let's move it forward because you still have one third. On that one third, where is your stop loss? Your stop loss is still at break even. Don't play around with the stop loss. Don't move it up. Okay. Just keep it at break even. Okay. Because you might want to ride the trend. What if it starts going up? Because this is a low volume close, which means it could still continue to go up. And it does. Right. So let's see when does it close now below that 10-week simple moving average. See, look at this bounce. What is this close? Strong close or weak close? It's a strong close because the closing is above the midpoint of the bar, and that too on high volume, and that too the stock has closed above the 10-week simple moving average, which means it is again a bounce. And you see what happens when the stock bounces of that 10-week, continues to go up, right? Let's move it forward. So don't get afraid with a red bar, okay? Continues to go up. Yes. See, this is your final closing uh, signal, because on this week the volume was still low, so still there is nothing to worry about, correct? But still, what did we plan initially when we bought the stock here? See, we bought it in 20th of November 2023, in that week. Now we are in July 2024. So it's been like 7 plus 1, it's been 9 months, 8 or 9 months we are in this story. So this trade has become like a story for us. Okay, it's been 8 9 months we have been holding on to this stock. So now it has closed below that 10-week simple moving average. In this week it came very close, this week it came very close, this week it closed below, so we sold. This week it came very close, but it bounced. So this is your final sell signal, because we initially planned that we will sell on a close below the 10-week simple moving average, irrespective of volume. If it had closed on high volume, we would have sold everything. Okay. So if you sell here, how much do you make? So from here till here, that's 97%. So 97%. So 97% plus 42% plus 19%, that's 158% on a one third position. Okay. So let me bring this back to here. Okay. What happened to the volume here? Yeah. Okay. Good. So you sold in three tranches. Let me put the text here. Okay. So first you sold 3.33% and you sold it at 19%, right? Then you sold another 3.33%. And on that position, you made how much? 42%, right? 42, yes. And 3.33%. Here you made almost 100%, but let me be specific and write 97%. So that's what we need to calculate. So so when you do a sum total of these three products, you get the total amount of money that you make on your portfolio. So 3.33% multiplied by 19% plus 42% plus 97%. Okay. Let's see how much it is. So this is 3.33% multiplied by 19 plus 42 plus 97 is 158%. Now, what is 3.33% of 158? Okay. 3.33% of is 5.26%. 5.26%. This is the amount of money that you make on your entire portfolio level from a single stock. So you sold in three tranches, right? That's the amount of money that you make on a portfolio level from a single stock. That's a huge return in 6 months from a single stock. Imagine if you had five stocks like this in your portfolio in 1 year. You just buy five stocks in 1 year. Okay. Five stocks in 1 year behaving like this. Okay. You are making 5% on each of those stocks on a portfolio level. So 5.26 multiplied by 5, you end up making 26% return on your portfolio just with five stocks. That's the beauty of positional stock trading. You don't have to do much. You just have to buy and sit tight and manage the trade. This is a simple trade management video. Okay. You are just managing the trade based with the help of a simple moving average. You are not analyzing each and every week: high volume, low volume, down closing, up closing, strong closing, weak closing. You are just ignoring everything and just following the simple moving average, which is the 10-week simple moving average. That gives you a fabulous return. This is like making 52% return on a 10% position size multiplied by 52.6%. See, this is equivalent to this, right? So we initially took 10%. So taking a 10% position size and selling it at 52% level is the same as taking a 10% position size and selling it in three different tranches. But the third tranche gives you the 100% return, which magnifies your return, right? So you overall end up making 5.26% on your overall portfolio from a single stock. That's a huge return. If you get if you get like 10 stocks like this in a bull market, and even if you sell partially step by step rather than selling everything in one go, I mean you end up with a 50% return annually. That's crazy, right? Plus, of course, you will, out of that 50%, some 10-15% will go away because you will also book some stop losses on your other trades. Not every trade you take will go in your favor, right? But sticking to this trade and sticking to what we planned and how we executed the plan is very simple. Selling three times, selling the stock three times, one third, one third, one third. So one third here in green zone, one third at a close below the 10-week simple moving average on low volume, and another one third with another close below the 10-week simple moving average on low volume or high volume. If it's high volume, then on the second time when you sold, if it was high volume, you would have sold all, right? At this 42%, you would have sold everything. You wouldn't have waited for the third opportunity to sell, right? So this is simple calculation. Okay. So that's the advantage of weekly positional trading. What did you do here? Your only activity was to buy on a Friday. That's the only thing that you did right in this entire story, in this entire 8 months. That Friday was a crucial Friday. If you had not bought on that Friday, you would have missed the whole story, right? So the breakout day is an extremely important day. If you managed to put 10% of your position, 10% of your portfolio in this stock on Friday, okay, then rest is very simple, right? You just have to observe and sell. See, buying is difficult, selling is not difficult, right? Because selling, you have clearly marked your milestones. You already have a plan in place. So you already have a trade management plan in place. So once you get into the train, or once you get into the boat, boarding off the boat is very simple, right? You know what is the time to sell. Once it hits your selling signal or once it hits your milestone, you start taking partial exits from the stock. And if at all it closes below the 10-week simple moving average on high volume, you know what to do. You come out completely. So your trade management plan was very simple. By the way, this is the most simplest way of managing a trade. Okay, so trade management is not as simple as this trade because things happen in 8 months, the market conditions change, the earnings of the stock get announced. So those are the things that will influence your decision making. You might end up selling earlier than you would want to, or sometimes if the fundamentals are great, the reported fundamentals latest, you might end up selling later than what you planned to do. Because if the fundamentals are improving, why would you want to offload your position, right? So I hope this trade management video was helpful to you. We will look at more charts. I mean, this is part number 41. Let me extract 9 more charts, weekly time frame charts. We will look at multiple scenarios as to what we can do. I will look at more trade management styles which I can help you with because trade management is very subjective. I start with an initial plan, but I seldom stick to that plan. My plan keeps changing as the stock shows movement because the market has become very dynamic. Suddenly, you might see a week in which the stock collapses like 27%. You can't hold on to that stock, right? So you have to be careful. So that's trade management for you, at least a starter. I discuss a bit of trade management in my video course. So do check out my video course. Plus, there is an opportunity for you to meet me. There is a link in the description box if you want to meet me on a Zoom call. You want to discuss things only for educational purpose. Okay, no advice. I don't give stock market related advice. Just for educational purpose. If you want to meet me, there are links in the description box. I will see you in the next video.